Welcome back. This is the ESOP Guy, and we are on this journey to an ESOP. So glad you could join us today. We are so committed to providing this ESOP podcast as a resource for you and thinking about what you might want to do with an employee stock ownership plan, that we're doing it on a podcast and a YouTube video on Christmas week. And so that just kind of shows you, as you go through this process of looking at it, there's a lot of information that you're going to need. And so, we can't just waste one whole week. So we're here to do that, and we're committed. If you have an interest in this podcast and want to look at other episodes, please go to our website at journeytoanesop.com. Also, we've been running and uploading some of these videos into the YouTube. And so you can go, if you go to YouTube and just put in the ESOP Guy, you're going to find all of our YouTube videos as well. So hopefully those are helpful for you as you go through the process of learning more about ESOPs. So today, what we're going to do is we're going to interview and have a discussion with Jamie Walrack with First American Bank. And Jamie's out of Elk Grove, Illinois, which is pretty close to Chicago. Is that right, Jamie?
That's right. We like to just say Chicago to avoid any sort of confusion whatsoever.
It's a big area. But so Jamie and I had talked a little bit about doing this video and this podcast a little while ago. He's a really representative of the ESOP lending arm in terms of doing an ESOP deal. What they would do is provide the financing. So what we're going to talk about today is the challenges of ESOP financing, and really just work through some of the questions that might be really helpful for you as you're thinking about when you go through the ESOP process. You're thinking about, hey, how am I going to get my money out of this? What's my liquidity event look like? And that's really what Jamie's team does. But before we start that, Jamie, I had a quick question because it is Christmas week. What is your favorite Christmas movie?
Oh man, that's a good question. I know a lot of people have been coming up with Die Hard a lot more recently, but I still can't see that as a Christmas movie. I showed my wife Christmas Vacation for the first time, and she just laughed her butt off. And so I'm going to put that one at the top of the list.
Vacation. All right. Well, and why is it your favorite? Just because it's funny?
Yeah, absolutely. Chevy Chase is fantastic, especially back when they were recording that. It's got a great cast, good combination of physical humor and then some nice sarcasm, which I always enjoy.
I think it's a good movie because you're, Christmas is so stressful, at least for some people. And it's like, you got to get all these gifts and packages and whatever, and everything's got to get wrapped, which is really hard, especially for guys. And you need a break. You need a little bit of a stress reliever, especially because it's the end of the year. And if you do ESOP deals, that at the end of the year, it's really stressful because we're all running around in circles. So, but cool. So awesome. So thank you for joining the podcast. Let's just start off with, give us a little background on you and the bank, a little bit about, because this is specific to ESOPs. How did you get into ESOPs? And then just kind of talk a little bit about your bank and what you guys do specific to ESOPs.
Great. First of all, thanks for having me, Phil. I really appreciate being on here. Getting the opportunity to spread the ESOP word. So a little background of the bank. We're a smaller privately held bank based out of Elk Grove Village, like you mentioned. Been around for over 50 years. The stock in the company is owned through primarily officers and one primary family who also heads it up as CEO. But a unique thing about us is we actually have an ESOP in place at the bank as well. So we've got a 9% ESOP in place, which allows us to share some of that ownership and practice a little bit of what we're preaching, which has been a plus. We got into the ESOP space more so as a defense mechanism. All of our clients are smaller, privately held businesses. Most previously were right around Elk Grove Village. Our headquarters in the middle of an industrial park. So we wanted to make sure that if one of our privately held clients came to us and said, hey, we want to put an ESOP in place, we didn't have to send them elsewhere. And as you know, once you do a transaction or two in the ESOP space, you get to know a few other people. It's a very small community. Our first transaction was actually referred to us by a larger bank. It was LaSalle Bank at the time, which is now Bank of America. And that client, who was too small for them at the time, has now grown to over $250 million in revenue and 1,200 employees nationwide. So really, it was more of a defense tactic, which ultimately grew into something that we've been able to really appreciate and enjoy. So that was 20 years ago, and still around and kicking over that period of time.
Oh, that's awesome. So going through, like, let's just start off with like the process of, what people really want to understand too, like the process of going through a loan approval. When you're going through that for an ESOP specifically, is there any differences between the loan approval process for a non-ESOP deal versus an ESOP deal?
Yeah, I would say you just kind of have to look at everything a little bit more closely, because during a traditional underwriting structure, you're looking at collateral, you're looking at cash flow. So you're kind of spreading the underwriting around on a bunch of different fronts. But in an ESOP, as you know, in most cases, there's usually a pretty substantial collateral deficiency. I have not run across one company that has as much assets as they do that they're looking for in a loan. For what the overall value of the company is, because ultimately, if the company had enough assets to cover the entire purchase price of the company, then the company likely wouldn't be doing very well to begin with. So you probably couldn't afford it on the cash flow. So I guess the biggest difference that I see is that you look at things more closely. You stress the cash flow a little bit more. So the reporting is the requirements are a little heavier from that perspective as well. And then on top of that, you need to potentially factor in a complete changeover in management or a complete changeover in ownership. We typically like to see the owner staying on for a period of time, or at least to have a management group that's been in place for a while. But in some cases, the owner is done. They don't want to be involved anymore, and they want to be able to take their money and ride off into the sunset. So that's another underwriting factor that you'd have to take a look at that wouldn't necessarily be if you were just doing an equipment loan or a mortgage or a line of credit.
That's a great point. In your process specifically, do you guys have a loan committee versus a signature authority? And if you want to comment on the differences between those two approval processes that banks tend to end up, gravitating to.
Yeah, so we're on the smaller side of things. So we've actually still got a loan committee. I sit on our senior executive loan committee, which meets every Monday, but technically is always in session. So we meet every Monday to kind of review the transactions, to go through it. I know some different banks, there is signature authority that goes through there as well. I would say it has its pluses and minuses. Both sides really do. From a committee perspective, obviously more people, potentially more questions, potentially more issues. But on the flip side of that as well, if you have one individual and a signature authority who just really doesn't like ESOPs, or really doesn't like the construction industry, or really doesn't like this thing or that thing, that one person that you're trying to convince, you're never going to get over the hump. As opposed to in a committee setting, you have perhaps a little more support from some of your peers or somebody else that could provide a more balanced approach to it, as opposed to just trying to have to get every loan approved by one or two individuals at a bank.
Yeah, I know. I think it's not as much, and part of it's to help the people understand the inner workings of how the process works, and, keeping it from that perspective. I remember, because I was a banker a long time ago, and I've done both loan committees and
you're a recovering banker.
I'm a recovering banker. I was a long time ago, but I appreciate the opportunity to kind of like help people understand, and I guess segueing into this next question, how hard might be sometimes for you guys. You're walking into an ESOP deal. So the question really here is more from a bank's perspective. What are the most difficult things that you see and challenges you see in walking into a potential ESOP deal?
Yeah, so from my perspective, being in the industry as long as we have, the first probably 3 to 5 years was really the most difficult of getting something up and running at a bank, because you're trying to convince a bunch of people who don't know how to spell ESOP what is going on, and why there's this huge collateral shortfall, why the owners are leaving, why the balance sheet's completely upside down, what's going on here, why are we looking to make this loan? From my perspective, I've benefited somewhat because we have been fighting those battles for a while, and we have that track record in place that's shown that, hey, these companies actually perform pretty well. This isn't like a private equity transaction where we're going to have to change over our customers every 3 to 5 years. These are longtime clients, and after they get done paying off the loan, they might be able to make acquisitions. They're accumulating a fair amount of cash on the balance sheet, and just generally, it's a very loyal client base because you're able to put something in place that not every other bank was able to provide at that given time.
Yeah.
But you need to understand your audience. I've got a committee full of varying different personalities and things that people like. I got an individual who really likes to see something that's extra sophisticated, so you put a little extra spice on it and make sure that they understand how sophisticated this company is. Another guy that really loves collateral. I typically don't have much for that guy, but we can try to work around things and and talk through how we're going to accelerate the loan payment, things of that nature. My boss always used to tell me that you have to make two sales. You have to make the sale to the company to sell the bank from that perspective, and then you have to sell it internally as well. And it's a lot of times they're two completely different sales pitches.
It's not easy, and not only that, the competition is fierce. I would imagine. So speak to that a little bit, because you guys you're in Elk Grove, which is Chicago, but you're doing deals all over the country. Is that correct?
Yeah.
Yeah.
So the competition, I would say, ebbs and flows as the economy ebbs and flows. Right now, we're in a cycle where there's just a substantial amount of liquidity within the market. There's a substantial amount of capital at a lot of these banks. And what they're looking to do is try to put it to work. So instead of trying to steal a customer from another customer, they're trying to come up with new ways to lend money. So in a lot of cases, these banks are at the same spot we were 20 plus years ago. So you go to some of these conferences and you've got 25 or 30 banks there instead of having 3 or 4. And it'll come back down again the first time that an ESOP loan goes bad, or if the economy goes into some sort of a recession or some sort of pullback, and there'll be a pullback on banks willing to lend in the ESOP space again. But what we've learned in being in it as long as we have is that you have to keep going. You have to keep attending. You have to keep making loans, because that shows your ability. There's always going to be somebody that can go out and provide a quarter point less on an interest rate. But if you show that you're willing and dedicated to stay in the space for a long time, that speaks volumes to a group that's a pretty loyal collection of individuals, as I'm sure you've run across.
Yeah. You tend to, kind of speaking into that a little bit, in the ESOP world, we talked about this at the beginning, is small. I mean, the community is small, even though we're all over the place in terms of geographically. I'm in Florida and you guys are in Chicago, but you tend to end up working with groups of people, and they tend to stick together. So, which I think is a really good aspect of the ESOP community is that people are very loyal to working together, and you tend to feel like you can really start to trust people and know what people are going to do as you start to develop those teams in a sense.
Makes the closings go a lot better.
I know,
as well, and a lot cheaper generally also.
Yeah, so people kind of have stay in the same lane, or the lane that you should be in. But you want the client, as I go from there to the client's perspective, you just want the client to not have any major surprises. I mean, that's one of the goals that I have in being a sell-side advisor, is really helping them to understand what's going to happen before it happens, so that you don't have the issue of a client getting really just upset with the whole process and wanting to say, just forget it. It's too much. And there are times in the ESOP process where it, even for me, it can feel like too much. And so one thought I had for a question for you, Jamie, is just, well, from a client's perspective, we can definitely see like what the bank has to do to get comfortable with an ESOP deal. And that's challenging. From a client's perspective, what's difficult to the client to deal with the bank, and have you thought through those types of things?
Yeah, the thing that I've seen a lot is a lot of our client base is like service-based companies. These are professional engineering firms, architecture firms, environmental consultants, whatever it might be. A lot of times when they're going into an ESOP transaction, they've never had to borrow any money before in their lives. They're at cash basis tax returns or internally prepared statements. They really don't have to rely on their accountant all that much. Maybe their accountant is a former brother-in-law or something like that, that the bank has never come to them and say, hey, we really need to dig into these numbers. So that can be a bit of a culture shock as well. And most people, once they understand the importance of having a good financial advisor, a good accountant on hand that can help them provide some substantial benefits to the company, they eventually come around. But that, on top of putting an ESOP in place, can be overwhelming. Like you mentioned, it's just one thing on top of another. Oh, I got to pay for this, or oh, I've got to do this now. While that ultimately creates a more professional organization that's more likely to be able to sustain in the long run, that does present as a challenge up front. The other big thing, especially on the deals that we typically look at, because we're on the smaller end, we're not a national bank that's looking at $100 million transactions. We're looking at the probably $2 to $25 million ESOP deal from a lending perspective. A lot of those companies, that they have an owner who's the rainmaker, who's the everything at the company. It's the individual who started the business. It's the guy who's the primary sales individual. He's running the operations, anything else from that perspective. The difficulty there is that the only way that you can create value within your business is if you can create a business that can run without you. And that's a huge challenge for a lot of these individuals, because the thing that made them successful, the thing that made the business successful at the beginning, was kind of taking everything on themselves, and being able to hand that off or find a individual that they can trust to run the company moving forward is a significant challenge. So asking those sorts of questions, people have to come to grips with their own mortality in some cases, that okay, maybe I'm not going to be the main guy or main gal running this forever. Maybe I need to bring some other people along here. But it's just any sort of ownership transition creates those types of questions, but then an ESOP is no different from that perspective.
That is true. And one of the things, and I'm glad you mentioned like the range of what you guys deal with, and I'm in that range too, is they really have to start early in the process of transitioning the responsibilities of the company. And so I always kind of separate ownership transition and management transition, because although they all kind of seem to work together, they're a little bit like you could start one before you even start the other, right? So I can start the management transition plan way earlier than I start my ownership transition plan. And I think that's super healthy to do that. I think it's super hard sometimes, especially if you don't have something on the ownership side to get people, more interested, and an ESOP though is beautiful in the sense that it does operate in a way that provides flexibility to really layer those together, so that I don't need my owner to leave immediately on a transaction. They can start to phase themselves out, but we have to prove, me and the client, and of course you guys have to see this, that the company could run in a way that really effectively without that person. And what year are we looking at, in terms of who's in that rank and file, or who's in that leadership team, and how are we going to incent them? How are we going to keep them? So that's a real big part of it, of doing it.
Yeah, I always like to look at an ESOP, because when you're looking at ESOP, and you know this from talking to your clients, maybe they're not just looking at ESOPs, they're also looking at a private equity sale, or they're looking at a strategic. Some of those are transactions. It's where you can kind of wipe your hands and walk away. I look at an ESOP more as a transition as opposed to a transaction. Obviously, there's some cash on day one that you get, but that's not where it ends. There's typically a 5 to 7 year, 3 to 7 year runway for those individuals to fully transition that on, because most individuals, like you mentioned, haven't started that process yet. Yeah. But they want to be able to gain some liquidity and take some chips off the table. And that's the beauty of an ESOP. You can do it all at once.
Well, and kind of to go back into the banking side, they're behind you guys. They're subordinated. So they have a stake in this, that they got to get paid their seller note. The seller note is going to be subordinate to the bank's note. The bank's going to get paid before they get paid. And so they need that company to thrive. They need it to continue to have success. So they're going to be as engaged, maybe as much as they were before, in a lot of ways. It's not just, hey, I can now forget about it, because how are you going to get your seller note paid if the company doesn't achieve its goals and objectives?
Yeah, it's aligning everyone's interest. This is the banker, the skeptical banker in me, but obviously there's a lot of different parties that are involved in an ESOP transaction. Once everything closes, I mean, it's ultimately it's the bank and it's the trustee and the company. And those are the people that you got to get comfortable with for the next 5, 10, 15, 20 years. So you want to make sure that you're starting off that relationship on good footing.
Exactly. And I'm glad you mentioned relationship too, because I think the key that I really look for is, as I said, transactions important, but you got to build a relationship with the bank and the people that you're going to do business with after the closing, so that you feel comfortable as the client saying, hey, I've got everything I need. I didn't just, manage a transaction. So for instance, if you need a line of credit, that needs to be underwritten. If you need, other types of financing because your business is growing so fast, that needs to be addressed early in the process. And then all the other stuff about a banking relationship that people don't tend to think about as much. What's the treasury services look like? What is it going to look like? Who am I going to deal with? Is it going to be somebody nice like Jamie, or am I going to deal with, a mean credit guy, which we can be mean to the credit people, because this is, this is our show, so we can do whatever we want. So with all of that, I guess, when I think about some of the challenges you guys face, is you're doing business in other states where you may not have an office. Describe that a little bit. Like if you have a client that you actually don't have an office in their state, how does that work from building a relationship?
Yeah, it's definitely a challenge, more so from that perspective, more so getting the client over that mental hurdle, I would say. I don't know about you, but I work at a bank. I don't remember the last time I was in a branch.
That's true, right?
Yeah, a client, we've got clients that are across the street from a branch here locally, and they've never been inside of it. But if you close that branch or you took it away, then all of a sudden people lose, oh, well, it used to just be right down the street. It's like, yeah, but you never went in it. But that's a hurdle to get over. But I guess the starting 20 years ago or 25 years ago when we put this in place, it was a lot more of a challenge than it is now. Technology has really helped that a lot through online banking, remote deposit capture. We're based out of, like you said, Chicago, O'Hare. You can get a flight pretty much anywhere, any time of day, to be able to make a stop. What I've found the most interesting, especially in the clients that size that we deal with, I showed up to a client in Fresno, California once, and we did a small ESOP transaction for a client out there who walked into their office and they're like, oh my God, this is the first time a bank has ever been in our office. I mean, this is a 25-year-old client. The bank was literally down the street. Their banker had never.
You're kidding. Wow.
Visited them.
You kind of that's banking 101, right? I mean, how do I even know what they do unless I go out to check out their place? So that's hilarious. Yeah.
It was shocking. So, I mean, you go to some of these places. So we've got clients in California who are obviously a 2-hour time difference. We've got clients in Florida, New Jersey who are an hour ahead from where we're at. It's just about creating that personal feel. The pandemic obviously created some issues from that perspective. This summer, I kind of went on a goodwill tour visiting clients that we hadn't seen in a year and a half because of travel restrictions and things like that. And it goes a long way. I mean, we're in it for a relationship. We're looking in it for the long term. We're not looking for just a 2 or 3 year transaction, something like that. We want to have long-term clients. That's the way the bank's thought process has always been. And that's what it'll continue to be, whether it's an ESOP, a private equity deal, commercial real estate, whatever it is. It's kind of applying those same things. And you mentioned it leading into this question as well, is kind of looking at the whole picture when you're structuring these sorts of transactions as well. Obviously, the big focus is how much cash can I get on day one. But if you create a loan that's too large and too cumbersome, then all of a sudden you can't make those equipment purchases that you wanted to make, or you can't take a look at that acquisition that you might have had in the hopper for a period of time. So it's setting the amortization, setting the loan amount, setting the structure so that it allows you to be able to succeed as a business. Because the ESOP itself is, I guess as a banker would refer to it, as non-productive debt. You're not buying equipment, you're not becoming more efficient, anything like that. Obviously, there's some substantial tax advantages, but it's adding debt, but it's not significantly benefiting the operations of the business. So you need to make sure that you don't lose sight of what makes the company great and what flexibility the company may need going forward.
Exactly. No, good point. All right. So let me throw out something very specific just to kind of get people like numbers, and it helps them to see things or in their heads maybe a little bit. So just throw it out to you. Like if you have a service-based company, they're just going to do a case study on the fly. Service-based company, they got no assets. Like they got AR, right? They don't have any real assets. They do on the last 5-year average, they did on average $2 million in EBITDA. And EBITDA, for everybody that doesn't know what it is, earnings before interest, taxes, depreciation, amortization. So it's just your cash flow. $2 million on average. Very like there's never a down year. It's just always pretty predictable, which bankers love. Now we do a forecast and we go in, we're going to do the ESOP deal. We do a forecast and the forecast shows a $3 million average EBITDA. So, and then we come and say, we're going to sell this thing for as much as we possibly can. Let's just say 3 times, say we're going to go for a $20 million enterprise value, just throwing it out. How much could you guys lend on that deal? And then what would be the particular structure, because you're really in an unsecured, airball situation where there's really not a lot of collateral. So your collateral guy and your committee's a little ticked off at you. So just give us like the particulars, and you're not, just consider this is a good company in a good industry. They've got, and you really feel good about the forecast too. I mean, like you see that they've grown the business and, $3 million EBITDA is very achievable.
Yeah. So that's typically where the separation happens. So obviously you're valuing a business, you're looking on kind of a discounted cash flow method. You're looking at forecasts, you're looking at those sorts of things. You're underwriting a transaction, you're more looking at the history. So given the consistency, I would say that would push us a lot closer to our 3 times multiple as far as the historical EBITDA. So on a $2 million, obviously that gets you up to 6, especially considering the consistency of those cash flows. Considering the lack of hard assets, the lack of fixed assets or long-term assets to match up with long-term debt, we would likely push it to anywhere from a 5 to 7 year amortization, but probably push a cash flow recapture in place, probably around 50% of excess cash flow, to turn that 5 or 7 year amortization into perhaps a 3 to 5 year amortization. What we've had a lot of success with our clients in doing, and it's somewhat more difficult to convince up front, is to take a more manageable chunk at the beginning, and then 12 to 18 months down the road, say the company did go from $2 million in EBITDA to $3 million in EBITDA in the first year. And so we, again, for numbers, so we started lending them $6 million. A year in, their EBITDA went from 2 million to 3 million. And they were able to accelerate the pay down on that debt. So at the end of year 1, instead of $6 million in outstanding debt, they're sitting on $4 million. So right now, a new 2 to 3 times EBITDA on a $3 million EBITDA company is up to $9 million, and we only have 4 outstanding. So 12 to 18 months in, we might add another $5 million debt to get it back up to that $3 million level. Cool. And then that sets sets it up so that a lot of clients or a lot of selling shareholders kind of have maybe a 10 to 15 year time horizon for everything to get paid off. They have that seller debt that's outstanding that they think that they can't touch until the senior debt's paid off. But if you can continue to kind of scoop over a little bit at a time as the company performs, then you can really work that down a lot more quickly.
Yeah. And I kind of left out there 100% ESOP. It's an S Corp. So you're going to get a complete tax exemption too. So, but that's good. I think that helps people to kind of see that you walk through. Now you've done all your stuff. We've got a term sheet. We're like, yeah, we like First American Bank. They're the best bank. We select you, you go to commitment, you go to the committee and get your commitment letter done. And so now we're ready to get this thing closed. All the stuff that's happened with the trustee is done. They've negotiated the price, and all the attorneys on that side are all good. Everybody's good. So the bank's coming in to do the closing. Walk through the closing process, like from a documentation standpoint, because you're going to have a legal counsel that basically manages your closing. And they're particularly not just any attorney that does bank closings. They have to be an attorney firm that understands ESOPs as well. That's true, right?
Yeah, absolutely. I would say that's key. Number one with a bullet is make sure that you bring in somebody that does not need to be educated as part of the transaction. That's where things tend to get expensive. Somebody once described it to me as the closing cost for a transaction being like a balloon. So you put together a balloon animal or something like that. So you got this long balloon. If you squeeze one end, the other sides get bigger. So if you're using cheap
like that
bank counsel, and you're paying a very small amount, but you're going to have to pay the other advisors in there quite a bit more because they're educating that guy. So that cheap individual pushed up the overall cost for the transaction because you needed to get them educated. You need to bring them up to speed. So that's something that we learned very early on, is make sure that you're represented by competent counsel. So that's been the big piece on that. The diligence process and the step towards closing really just all depends on the collateral. So if it's a heavy asset-based, maybe a field exam that might need to be performed. If there's real estate involved, obviously you need to do some sort of appraisal, environmental. But in the scenario that you talked about, where it's a environmental service firm, perhaps, or some sort of professional services firm where there's no collateral, then it's ultimately just reviewing the ESOP documents that have been completed to this point by the trustee and company counsel and trustees counsel, and making sure that has the proper provisions in that as well. And then just working towards closing. You can definitely tell a difference with a transaction that has kind of a clear leader who's going through it, somebody who's really driving the pace, who's setting the calls. Those deals tend to get done quicker and on time, as opposed to sometimes it can be a little bit rudderless. So on occasion, our attorneys have had to step in to direct the ship a little bit. But if there is a transaction that does have a kind of a proper quarterback, then those things tend to go a little bit more smoothly, because it's somebody that's kind of looking after the whole transaction to make sure that you have everybody still working towards a close.
Yeah, I think that's a good point. In your mind, who should be, in the closing step process, who should be leading the charge in that? Because it does tend to gravitate towards, to me, like to different people sometimes.
Yeah, so I mean, if you have an investment banker, obviously that's what they're getting paid for. They're getting paid to get this thing to close. And that's usually the individual who takes charge. Some firms, if you don't necessarily have somebody who's doing like a sell side advisory where they're shopping this thing out, a lot of people will just lean on somebody who's doing the administration or somebody who's doing something else like that, where they kind of have a more limited role. And then in that case, those people are less willing to step up into that role because perhaps it's not something they're comfortable with. Maybe it's not something that was factored into whatever their fee might be. But ultimately, somebody needs to kind of take charge along the way. And I've seen it from the company side. I've seen it from the bank side. I've seen it from the trustee side. It's just whoever kind of feels most comfortable, perhaps who's been in it the longest and understands the whole process.
Yeah, no, I think that's important, because the worst thing is a frustration is created because you're not on track to close, having a good closing date, and then everybody working towards that closing date. And then I think one of the things I would describe it as is orderly chaos, because you do have so many people involved. And I was telling Jamie, I've got 2 calls today for 2 closings before the end of the year. And I want to say we probably have 15 people on these calls, each one of them, because the attorney firms probably have 5 people, several bankers, several, people on the ESOP attorneys on, and then you have the trustees on, and then you have it's just, and then we're going to put the TPA on too, to make sure everybody's there, but it's just a lot, and so
those are expensive phone calls.
Who's on what? Yeah. What's on first? It's like, yeah. So you do have to have a little bit of, I kind of tend to like to lean heavy on the ESOP attorney to move things through, because a lot of the documents are generated from their place, in making sure that they're staying on top of it all. But it is definitely different probably for each deal, depending on the personalities and the people that you're dealing with. So with a client, I usually just say, look, let's get a closing date and make sure we've communicated that to everybody involved. And every time we get something going on, we need to make sure we keep coming back to the timing of the closing date, so that we can keep it moving. And I think partly we do want to do that because of the expenses. The expense of a closing can, like you said, it can go crazy depending on who's getting what done or what documents have to be re-reviewed or whatever. If, you have people that are putting together documents that have not had a lot of experience in the ESOPs. So those are things that I think are points that we could hopefully glean to avoid frustration in an ESOP deal.
Yeah, and the longer those things tend to drag out, the more expensive they tend to be. So keeping everybody on track is very important.
Yeah. So we're almost ready to kind of close. I guess the final question would just be kind of, what would you say, in your experience, were issues that you're like, from going through the ESOP process with a new opportunity or a client, that could have been avoided or would have been just kind of avoiding pitfalls or things that you've seen just in experience that might be helpful for people to be thinking about early on in the process?
Yeah, I think making sure that you give yourself time to understand that full transition, I think, is really important. Try to jam these things through. It leaves people with kind of misunderstandings, whatever that might be the case. I think being as transparent as possible throughout the entire process as well, just so you don't get to closing. And I mean, it's an emotional time as it is. You're selling the company, everything else is going like that. And you get an unexpected bill or something else that might be coming along, just to make sure that you're continuing to communicate throughout the process as far as what's happening, who's going on. They always say bankers hate surprises. I think most people hate surprises. It's just a matter of making sure that you're working with a team that you're comfortable with, that you're confident will share good news, bad news, indifferent, whatever it might be, so you can kind of work through these things together. The last thing that you want, some people do this just to kind of posture for their clients, is they're really upset about something or try to make a bigger deal out of something than it is, as opposed to approaching it with kind of a level-headedness to kind of say, okay, this is an issue we're having. Is there some middle ground that we can kind of come to, as opposed to throwing a tantrum in front of everybody just to try to make it seem like you're earning your money for your client. So that can
make an emotional appeal to,
yes.
Yeah, I mean, it's deal making itself by itself, like without an ESOP or whether it's still getting a deal done. So there's certain aspects of that are just principles, I think, that should be followed. And partly the complex part about an ESOP is that there's so many people involved, where in some other deals, it's just as simple, it's a lot more straightforward when you have less personalities involved. And honestly, I think partly the clients that are not educated really well in the front end, they can come off, they just don't know. And then, like you said, they're surprised, but they really shouldn't be surprised, because we all have the job of educating them. And that's really what this podcast is about, is to help, explore some of these, maybe difficult questions or thoughts that they might be thinking, or they need to be thinking about, or asking those questions early on, so they don't get into that situation. And who knows, they might just enjoy the ESOP closing, That might be their.
It's supposed to be a happy time.
It should be a happy time, because here's some money coming, right? And if it was all done correctly. So anyway, I just want to say thank you so much for your time today, Jamie. It was really helpful, for people to understand a little bit more about how your world works. And so I appreciate you being on the podcast.
Well, thanks for having me. I really appreciate doing this.
So with that, I just wanted to say thanks everybody for listening today and joining us on this podcast, and have a Merry Christmas, have a Happy New Year, and we'll see you on our next step on this journey to an ESOP.